Before you scroll, before you answer a message, before you let anything pull your attention away, give me a few minutes. Because what I'm about to explain is not hype, not clickbait, and not some internet fantasy. This is about a structural shift in the global financial system that most people wanted to understand until it was already cost them real money. Something happened this week that hasn't happened since the 1990s, and almost nobody in mainstream media is talking about it properly. Central banks around the world now hold more gold in their reserves than U.S. Treasury debt. Let that sink in. For the first time in roughly 3 decades, gold has overtaken American government bonds as the preferred reserve asset of central banks. That is not a small technical detail. That is a major signal about trust. For the last 50 years, ever since the Bretton Woods system collapsed in 1971, the U.S. dollar has sat at the center of the global financial system. Countries held dollars in U.S. treasuries because that was the safest, most liquid place to park their reserves. You needed dollars to buy oil, to settle international trade, to stabilize your currency. The system revolved around U.S. debt. But that system only works if the rest of the world believes 2 things: that the dollar will hold its value over time, and that access to it cannot be politically taken away. Both of those assumptions are now in question. The U.S. debt has exploded. Trillion-dollar deficits are no longer an emergency measure, they're normal policy. The national debt has gone from around 10 trillion to over 36 trillion in little more than a decade. Every crisis is met with more borrowing and more money creation. And every new dollar reduces the purchasing power of the existing ones. Foreign governments see this. They are not stupid. They run finance ministries, not group chats. Quietly, year after year, they've been adjusting their behavior. China, Russia, India, Turkey, Saudi Arabia, Poland, and many others have been steadily increasing their gold reserves. Not dramatically overnight, but persistently. This wasn't a panic move. It was a long-term strategy. And now the numbers have crossed an important threshold. Collectively, central banks hold more gold than U.S. treasuries. That is a vote of no confidence. Not a dramatic public announcement, not a press conference, just a silent shift in behavior, the kind that really matters. Gold is attractive right now for very simple reasons. It cannot be printed. It is not someone else's liability. It is not controlled by any government. It cannot be frozen with a keystroke. And after the U.S. and its allies froze Russia's dollar reserves, every country on earth took notes. Because once you weaponize the reserve currency, everyone realizes they're holding a political instrument, not just a financial one. If it can happen to Russia, it can happen to anyone. So gold is becoming neutral money again. Not officially, but functionally. And when central banks start acting this way, private capital follows. Large institutions, corporations, family offices, and eventually retail investors tend to move in the same direction, just later. That brings us to silver. Silver is not just a precious metal. It is a monetary metal with an industrial backbone. It sits at the intersection of finance and technology. It is used in solar panels, electronics, medical equipment, and defense systems. Unlike gold, most silver gets consumed. It doesn't just sit in vaults. Historically, when confidence in paper currencies weakens, gold moves first. Silver moves second, and faster. Silver is gold's smaller, more volatile sibling. It doesn't walk into bull markets, it sprints. And when monetary stress appears, silver tends to outperform gold on a percentage basis. That's why it's often called the poor man's gold. Not because it's inferior, but because it's more accessible and more explosive. And that brings us to what happened this week in the silver market. Silver recently surged to around $92 per ounce, up from roughly $30 just 6 months ago. That is not a normal move. That is a repricing event. Then, while Western markets were closed and liquidity was thin, silver suddenly dropped about $5 in a matter of hours, from around $92 to $87. A lot of people woke up, checked their accounts, and panicked. They assumed the rally was over. They thought this was the start of a collapse. It wasn't. This wasn't profit-taking. This wasn't a healthy correction. This was a defensive maneuver. The large commercial banks have been heavily short silver for years. That means they've sold massive amounts of silver contracts they don't physically own, betting that the price would stay flat or fall. This has been a profitable strategy for a long time in a manipulated, slow-moving market. But it becomes lethal in a fast-moving bull market. According to recent data, commercial banks are short roughly 4.4 billion ounces of silver across futures, derivatives, and related contracts. At $90 silver, that represents exposure of nearly $400 billion. To put that in perspective, that is larger than the entire market capitalization of some major U.S. banks. In plain English, if silver keeps rising sharply, these positions threaten the solvency of institutions that are considered too big to fail. This is not a theory, it's arithmetic. When prices rise against a short position, losses grow exponentially. At a certain point, it stops being a bad trade and starts becoming a systemic risk. So what do banks do in that situation? They try to force the price down. Thin overnight markets are the easiest place to do it. Low liquidity means relatively small volumes can cause large price moves. A sharp drop triggers stop losses, spooks retail traders, and creates the illusion that the rally is broken. It buys time. This is not about making money anymore, it's about survival. If silver stays high and continues rising, the losses on these positions could exceed the capital base of major financial institutions. That is how a commodity market turns into a financial stability issue. And here is the key point most people miss. When a short position of this size becomes trapped, the upside becomes violent. Shorts must eventually buy to close their positions. That buying becomes fuel for the next leg higher. This is how squeezes are born. Combine that with growing distrust in fiat currencies, central banks accumulating gold, persistent inflation, and industrial demand for silver, and you have the ingredients for a structural bull market, not a speculative spike. This is not just about silver being a trade, it's about silver being a signal. It reflects stress in the monetary system. Gold tells you trust is eroding. Silver tells you stress is accelerating. None of this means prices move in straight lines. Volatility will be extreme. Pullbacks will be scary. That is the nature of real bull markets. But the underlying driver is not a social media trend. It is a global reallocation of capital away from paper promises and toward hard assets. We are watching a slow motion shift in what the world considers real money. And those shifts don't reverse easily. The last time we saw this kind of monetary realignment, it reshaped markets for decades. Most people won't pay attention until it shows up in grocery bills, mortgage rates, and pension funds. By then, positioning is no longer opportunity. It's damage control. You don't need to panic. But you do need to understand what is happening, because when central banks change their behavior, they are telling you something long before they ever say it out loud. And right now, they are telling you they trust metal more than paper. That is not noise. That is the signal. What we witnessed wasn't a normal market dip. It was a controlled demolition. Overnight, while most of the world was asleep, the price was slammed. Huge volumes of paper silver were dumped into the thinnest trading hours in Asia and Europe. Not because someone suddenly lost faith in silver, but because someone needed the price lower, fast. This is a classic playbook move. You flood an illiquid market with contracts, the price drops sharply, stop-loss orders get triggered automatically, leveraged traders are forced to sell and fear spreads. It looks organic, but it isn't. It's financial judo. And yes, it worked in the short term. The banks bought themselves some breathing room. But here's the part that actually matters. They didn't solve anything, they just hit the snooze button. The underlying problem is still there. The physical shortage did not disappear overnight. Industrial demand didn't suddenly collapse. The vaults did not magically refill while everyone was sleeping. All they did was create a temporary illusion. Think of it like putting duct tape on a cracked dam. You might slow the leak for a moment, but the pressure behind it is still building. And that pressure is visible in the one place paper games can hide it, the physical market. While the paper price was being pushed down from the low 90s into the high 80s, something very strange was happening behind the scenes. Silver lease rates went vertical. Lease rates are the cost of borrowing physical metal. If you're a manufacturer who needs silver for production, or a trader who must deliver metal against a contract, you can borrow silver and pay a fee. In a healthy market, that fee is tiny, maybe 0.5% to 1% per year. That's what abundance looks like. Today, that is not what we're seeing. Lease rates have been spiking to 5%, 10%, even 15% and 20% in certain markets. That is not normal. That is not noise. That is desperation pricing. No one pays 15% annualized to borrow metal unless the metal is extremely hard to find. This is what happens when physical supply is tight and immediate demand is urgent. People don't want a promise for 6 months from now. They want the metal today. That condition has a name: backwardation. It's when the spot price is higher than the futures price. In plain language, it means the market is screaming, "We need the real thing now, not later." Backwardation in a major commodity is a red alert. It tells you the paper market and the physical market are no longer in sync. So while the headline price was flashing red, the physical market was flashing neon green. This is the disconnect that matters. The paper price says, "Nothing to see here." The physical market says, "We're running out of metal." That is why the smash doesn't end the rally. It confirms it. And then we got confirmation from the other side of the world. Shanghai just made a move that should make anyone paying attention sit up straight. The Shanghai Futures Exchange announced new position limits on silver. They cut the maximum position size from 7,000 contracts to 3,000 contracts. That is a 57% reduction. Exchanges do not do this casually. They do it when they are worried about stability and delivery. When too many people want physical settlement and there isn't enough metal to go around, the exchange has a problem, a big one. So they step in and force traders to reduce exposure. They shrink the size of the bets. They try to cool the market down before it overheats. This is not a sign of confidence. It is a sign of strain. Shanghai is not a minor venue. It is the largest physical silver exchange in the world. This is where real metal flows, not just paper contracts. If Shanghai is tightening the screws, it means they see inventories draining and delivery pressure rising. In other words, the world's biggest physical silver market is telling you supply is tight. That is not something you do in a market that is fine. This is what the end game looks like in slow motion. First, the physical market tightens. Then exchanges start imposing limits. Eventually, paper credibility erodes. And when the paper market loses credibility, price discovery shifts to the physical market. That is when prices don't move in dollars anymore. They move in leaps. Now let's deal with the rumor mill because it caused unnecessary panic. A story started circulating that Rick Rule had sold all his silver. For a lot of investors, that name carries weight, and suddenly people were thinking, if he's out, should I be out too? Here is what actually happened. Rick Rule did not abandon silver. He rebalanced. He sold about 80% of his physical silver position, not because he turned bearish, but because he had a massive gain. He took back his original capital, paid his taxes, and secured profits. That means the remaining 20% is effectively house money. At the same time, he increased his exposure to silver mining stocks. Why? Because miners offer leverage. If silver goes from $90 to $150, the metal might rise 60%, but a well-run miner's cash flow could double or triple. Smart investors rotate risk. They don't marry positions. This is not capitulation. This is portfolio management. If Rick Rule were bearish on silver, he would be exiting the entire space. Instead, he is shifting into higher octane exposure. That is not a warning sign. That is a vote of confidence with a seatbelt on. And finally, we come to the long-term framework that ties everything together. A major asset management firm recently updated its gold forecast using the Jim Sinclair model. Jim Sinclair was legendary in precious metals because he correctly anticipated the gold bull market of the 1970s. The model is simple in concept, but brutal in implication. It takes the total money supply and divides it by the gold held in reserve. The result is what gold would need to be priced at to credibly back the currency supply. In 2007, when gold was around $700, Sinclair said the math pointed to $50,000 gold over time. People laughed. But the logic was straightforward. If governments keep expanding the money supply, the currency must eventually be devalued relative to hard assets. Since then, money creation has accelerated dramatically. Trillions have become routine. Balance sheets that once seemed extreme now look modest. Every new dollar makes each existing dollar worth a little less. Gold doesn't change. The measuring stick does. This is why central banks are buying gold. It is why physical silver is tightening. It is why paper interventions are becoming more aggressive. We are not watching a normal commodity cycle. We are watching a slow repricing of money itself. The overnight smash was not strength. It was stress. When institutions start acting defensively, when exchanges tighten rules, when physical markets contradict paper prices, you are not near the end of a move. You are in the messy middle, the kind of middle where volatility is violent and conviction is tested. The story is not that silver dipped $5. The story is why it had to be smashed at all. Because confident markets don't need emergency tactics. Stressed ones do. At some point, every monetary system reaches the stage where the math stops working and only confidence keeps it alive. When that confidence cracks, the numbers take over. And right now, the numbers are getting very uncomfortable. Years ago, legendary gold investor Jim Sinclair built a simple but brutal model. He said, if governments keep expanding the money supply, one day gold will have to be revalued to restore credibility to the system. Not because politicians want to, but because markets force them to. Back in 2007, when gold was trading around $700 an ounce, Sinclair warned that the long-term math pointed to $50,000 gold. People laughed. It sounded insane. But then gold ran to $1,900 over the following years. Not all the way to his target, but enough to prove the direction was right. Today, that same model has been updated with current data, and the result is far more extreme. Using today's money supply numbers, some analysts are now arriving at a theoretical gold price of $184,000 per ounce. Not 4,000, not 10,000, 184,000. Before you roll your eyes, understand what this actually means. This is not a short-term price target. It is a stress test number. It asks the simple question, if gold had to credibly back the existing money supply, what would it be worth? In the US alone, M2 money supply is now over $21 trillion. Official US gold reserves are about 260 million ounces. Divide one by the other and you already get a number near $80,000 per ounce. That is just the United States. When you expand the calculation to the global money supply, the number rises dramatically. That is how you arrive at figures like $184,000. This is not a prediction that gold is going there next year. It is a measurement of how distorted the monetary system has become. The gap between paper money and hard money is now enormous. And this is why central banks are quietly accumulating gold. They are not doing this for fun. They are doing it because they understand the architecture of the system is weakening. Now here is where silver comes in. Historically, the gold to silver ratio has averaged around 15 to 1. That means 1 ounce of gold buys 15 ounces of silver. In modern times, the ratio has been much wider, often 60 to 1 or more. If gold were ever revalued dramatically higher, silver would not sit still. Even at a conservative 60 to 1 ratio, $184,000 gold implies silver over $3,000 an ounce. No, that does not mean silver is going there next month. It means that the long-term upside is not capped at $100 or $200. So when people talk about $300 or $500 silver, that is not aggressive. In the context of systemic reset math, it is restrained. Now connect the dots. Central banks are reducing reliance on dollars and increasing gold holdings. Commercial banks are trapped in massive silver short positions. Shanghai is cutting position limits because physical supply is tightening. Lease rates are exploding because metal is scarce. Major investors are rotating into higher leverage silver plays. And long-term models are signaling that currencies are fundamentally mispriced against hard assets. These are not random events. They are symptoms of the same disease. The monetary system is under strain. That is why emotional reactions to small price moves are so dangerous right now. If you own physical silver and you panic over a $5 dip, you are trading noise instead of understanding structure. Nothing fundamental changed when silver dipped from the low 90s to the high 80s. The shortage did not disappear. Industrial demand did not vanish. Vaults did not refill overnight. Shanghai did not reverse its decision. Lease rates did not collapse. Only the paper price moved, and paper prices can be pushed around. Physical reality cannot. This is why owning physical metal is different from owning a ticker symbol. In a true crisis, paper instruments can be frozen, settled in cash, or restructured. Physical metal cannot be printed or settled with excuses. If you hold paper silver only, you should think seriously about counterparty risk. In a force majeure event, you may be paid in dollars at yesterday's price, while physical silver trades much higher elsewhere. That is not a theoretical risk. It is written into many contracts. And if you do not own any silver at all, understand that availability matters as much as price. In tight markets, you may find that metal is not available at any reasonable premium, regardless of what the screen says. Markets do not ration by price alone. They ration by access. As for those waiting for silver to fall back to $70, ask yourself what would cause that in reality. Would industrial demand collapse overnight? Would central banks suddenly regain trust in fiat currencies? Would physical inventories suddenly surge? Or would it require continuous intervention to suppress price against rising fundamentals? Temporary drops driven by manipulation do not reverse structural trends. They delay them, and delays often make the eventual move more violent. If silver pushes through $100, the pressure on short positions becomes extreme. The losses move from uncomfortable to destabilizing. That is when official responses begin to matter. That is when bailouts, rule changes, and emergency measures appear. Markets rarely break quietly. They break when stress reaches a level no one can manage. As for timing, nobody can give you a calendar date. Markets do not send invitations, but the signals are no longer subtle. Tight physical markets, exchange intervention, central bank behavior, and institutional stress all point in the same direction. This is not a 10-year away story anymore. We are in the late innings. That does not mean every day is green. It means volatility will be intense because the stakes are high. And finally, consider the psychology of the banks. Institutions that feel safe do not smash markets in the dead of night. They do not need to. Institutions under pressure do. Desperation is not a sign of strength. When your counterparty is nervous, that is not the moment to abandon your position out of fear. That is the moment to understand why they are nervous. This is not about cheering for chaos. It is about recognizing reality. The world is slowly repricing what money means. Gold is being treated as a reserve asset again. Silver is being exposed as scarcer than most believed. And paper promises are being tested. Do not let short-term volatility distract you from long-term structure. $5 moves are tactics. The reset is strategic. And when the physical market finally overwhelms the paper market, the repricing will not be gentle. That is why patience, not panic, is the edge right now. Because when this turns from a price story into a credibility story, the move will already be underway. And by then, the metal will not be waiting on the shelf.